Most investing advice fails because it assumes you're perfect. This 5-step rule assumes you're human. Most people believe investing success comes from being smarter than everyone else, spotting opportunities others miss, or discovering some clever shortcut. That belief is comforting because it suggests that failure is caused by a lack of intelligence rather than behavior. In reality, investing is far less about brilliance and far more about avoiding obvious, repeatable mistakes. History shows that even very intelligent people lose money when they allow emotion, ego, or impatience to override sound judgment. The average investor does not need exceptional insight to succeed. They need the discipline to not sabotage themselves. Avoiding stupidity sounds unimpressive, but it is one of the most powerful advantages available to ordinary people. Stupidity in investing rarely looks foolish in the moment. It often feels justified, urgent, or even rational. Buying something because everyone else is making money feels sensible. Selling because prices are falling feels responsible. Concentrating everything into one exciting idea feels confident. These actions are usually driven by fear of missing out or fear of losing what has already been gained. The problem is not that these emotions exist. The problem is acting on them without a system to restrain them. When emotions take control, logic becomes a servant instead of a guide. Investors then invent reasons to support decisions they already feel compelled to make. Chasing brilliance often means chasing complexity. Complex strategies give the illusion of control and intelligence, but they increase the number of things that can go wrong. Each additional moving part introduces new risks, hidden costs and opportunities for error. Simple approaches, on the other hand, reduce the surface area for mistakes. They are easier to understand, easier to monitor, and easier to stick with during stressful periods. Simplicity does not guarantee success, but it dramatically lowers the odds of catastrophic failure. In investing, survival is underrated. You cannot benefit from long-term compounding if you remove yourself from the game through a single bad decision. Another form of stupidity is overconfidence. A few good outcomes can convince people they are more skilled than they actually are. This leads to larger bets, less diversification, and a growing belief that normal rules no longer apply. Overconfidence is especially dangerous because it feels like competence. The market has a way of humbling this behavior, often suddenly and painfully. Avoiding stupidity means recognizing the limits of your knowledge and building safeguards around those limits. It means assuming you can wrong even when things are going well. Humility is not weakness in investing. It is protection. Impatience is another common error disguised as ambition. Many people abandon sound strategies because progress feels slow. They confuse lack of excitement with lack of effectiveness. Compounding works quietly at first, and that silence can be uncomfortable. In response, investors seek action, novelty, and faster results. This often leads to frequent changes in strategy, increased trading, and inconsistent behavior. Each switch resets progress and introduces new mistakes. Avoiding stupidity means accepting that meaningful results take time and resisting the urge to constantly intervene. Time is not the enemy, interference is. There is also stupidity in trying to look smart. Investors sometimes choose strategies they do not fully understand because they sound impressive or sophisticated. This creates a dangerous gap between confidence and comprehension. When things go wrong, they cannot diagnose the problem or respond calmly. Understanding is a form of risk management. If you cannot explain why you own something and under what conditions you would continue to own it, you are relying on hope rather than judgment. Avoiding stupidity means staying within your circle of understanding, even if that circle feels modest. Comparing yourself to others is another trap. Seeing others achieve rapid gains can make steady progress feel inadequate. This comparison distorts decision-making and pushes people toward unnecessary risk. The market does not reward jealousy. It rewards patience and discipline. Avoiding stupidity means measuring success by adherence to a sound process rather than by short-term outcomes or external validation. You do not need to win every year. You need to avoid losing in ways that prevent recovery. Finally, avoiding stupidity means respecting human nature instead of pretending it does not exist. You will feel fear during downturns and excitement during booms. A good investing approach anticipates those feelings and limits the damage they can cause. Rules, automation, and clear boundaries exist to protect you from yourself. Brilliance fades. Discipline compounds. Over a lifetime, the quiet act of avoiding obvious mistakes will outperform most attempts at being clever. Most people believe the core skill in investing is prediction. They watch prices, follow experts, study charts, and consume endless commentary, all in an effort to forecast what will happen next. This focus feels logical because the future seems like the only thing that matters. Yet prediction is where most investors quietly fail. The future is uncertain by nature, and markets incorporate expectations faster than any individual can react. When you make prediction the center of your strategy, you place your results in something you cannot control. Owning assets, by contrast, shifts the focus from guessing outcomes to participating in long-term value creation. That shift alone dramatically improves decision-making. Ownership forces a different mindset. When you see yourself as an owner, not a trader, your relationship with price changes. Price becomes information, not instruction. A lower price does not automatically mean danger, and a higher price does not automatically mean success. What matters is whether the underlying asset continues to produce value over time. This perspective removes much of the emotional volatility that causes people to buy high and sell low. Owners think in terms of durability, usefulness, and long-term economics. Predictors think in terms of timing, signals, and short-term reactions. One mindset builds wealth slowly. The other usually transfers it. Prediction also creates the illusion of control. It tempts people to believe that with enough data, analysis, or effort, uncertainty can be eliminated. In reality, uncertainty can only be managed, not removed. Markets are influenced by countless variables, many of which are unknowable or irrational. Even accurate predictions can be ruined by bad timing or unexpected events. Ownership accepts uncertainty as a permanent feature. Instead of fighting it, ownership uses diversification, time, and patience to make uncertainty less dangerous. This approach does not require being right often. It only requires avoiding being disastrously wrong. Another weakness of prediction is that it demands constant attention. If your strategy depends on anticipating changes, you must continuously monitor news, prices, and opinions. This creates mental fatigue and increases the chance of emotional decisions. Ownership simplifies life. Once you own assets you believe in, your job becomes maintenance rather than surveillance. You check occasionally, make adjustments deliberately, and otherwise let the system run. This frees cognitive energy for work, family, and personal growth. Investing should support your life, not consume it. Prediction also encourages short-term thinking. When the goal is to anticipate the next move, time horizons shrink. This increases trading costs and taxes, all of which quietly erode returns. Ownership lengthens the horizon. When you expect to hold something for years, small fluctuations lose their power. This does not mean ignoring reality or refusing to adapt. It means distinguishing between temporary noise and permanent change. Owners are patient but not blind. Predictors are alert but often reactive. Over time, patience tends to be more profitable than constant alertness. There is also a psychological advantage to ownership. When you predict, you tie your identity to being right. Being wrong feels personal and painful. This can lead to denial, defensiveness, and doubling down on bad ideas. Ownership separates ego from outcome. You do not need to prove your intelligence. You need to steward your capital responsibly. Mistakes become part of the process rather than threats to self-worth. This emotional distance improves judgment and resilience. For average people, ownership is especially powerful because it aligns with real-life constraints. You have limited time, attention, and energy. A strategy that requires frequent intervention is fragile. A strategy based on ownership is robust. It continues working when you are busy, distracted, or uncertain. It scales naturally as income grows and responsibilities change. You add to ownership gradually rather than constantly reinventing your approach. Finally, owning rather than predicting reinforces a crucial truth: wealth is built through participation, not perfection. You do not need to catch every opportunity or avoid every downturn. You need to remain invested in productive assets long enough for growth to compound. Prediction tempts you to jump in and out, often missing the most important periods. Ownership keeps you present. It allows time to do the work that skill alone cannot. Over decades, that difference becomes enormous. Consistency sounds ordinary, almost too plain to be powerful. Yet nearly every durable success in investing can be traced back to a pattern of reasonable actions repeated over long periods. Cleverness attracts attention, but consistency builds results. Many investors search endlessly for the next smart move, believing that a single brilliant decision will change everything. What they overlook is that outcomes are shaped far more by what you do repeatedly than by what you do occasionally. A mediocre decision executed consistently often beats a brilliant decision executed sporadically or emotionally. The attraction to cleverness is understandable. Clever ideas promise speed, efficiency, and superiority. They appeal to ego and to the desire to feel in control. Unfortunately, clever strategies are often fragile. They depend on specific conditions, precise timing, or continued insight. When those conditions change, the strategy breaks. Consistency, on the other hand, is resilient. It does not rely on being right about the future. It relies on showing up again and again with reasonable behavior. Markets reward that resilience more often than they reward intelligence. Simplicity is the natural partner of consistency. The more complex a system becomes, the harder it is to maintain under stress. Complexity increases decision points, and each decision point is an opportunity for error. Simple systems reduce friction. They make the correct action obvious and the incorrect action harder to justify. This is especially important during periods of volatility when emotions run high and clarity is scarce. A simple, consistent approach acts like a guardrail, keeping you on course when visibility is low. One of the most practical expressions, consistency, is regular investing. Contributing on a fixed schedule removes the burden of timing and replaces it with habit. You are no longer debating whether now is the right moment. You invest because it is part of the routine. This routine transforms market fluctuations into background noise. Down markets become opportunities to accumulate more at lower prices. Up markets reward past discipline. Over time, this rhythm smooths out volatility and reduces regret. You are not trying to be smart. You are trying to be steady, Cleverness often leads to overreaction. When investors pride themselves on insight, they feel compelled to act on it. This results in frequent changes, adjustments, and course corrections. Each action carries costs, both visible and hidden. Transaction fees, taxes, and slippage quietly erode returns. More importantly, constant action increases the risk of being out of the market during critical periods. Consistency avoids this trap by minimizing unnecessary movement. You stay invested, you stay aligned with your plan, and you let compounding operate without interruption. There is also a psychological benefit to consistency. Decision fatigue is real. The more choices you make, the poorer those choices tend to become. A consistent approach reduces the number of decisions required. You decide once, then follow through. This preserves mental energy and reduces stress. Investing becomes less of an emotional roller coaster and more of a background process. When stress is lower, judgment improves. When judgment improves, results follow. Clever strategies often depend on external validation. They require confirmation from markets, experts, or peers to feel justified. This creates vulnerability. When validation disappears, confidence collapses. Consistency is internally validated. Success is measured by adherence to process rather than by short-term outcomes. This creates emotional independence. You are less affected by opinions, headlines, or temporary underperformance. That independence is a competitive advantage because it allows you to act rationally when others cannot. For intermediate investors, the temptation to abandon consistency often comes after early success. A few good outcomes can create the belief that skill has replaced luck. This belief encourages experimentation and increased risk. Consistency counters this by keeping behavior grounded. It reminds you that outcomes fluctuate, but principles endure. Staying consistent through both success and failure prevents small wins from turning into large losses. Ultimately, consistency and simplicity are not about settling for less. They are about removing obstacles that prevent long-term success. Cleverness fades, conditions change, and confidence wavers. A simple, consistent approach endures. It aligns with human limitations instead of fighting them. Over years and decades, that alignment compounds quietly but powerfully, turning ordinary behavior into extraordinary results. Patience is often misunderstood as passivity, as if it means waiting without thought or effort. In investing, patience is something varied. It is an active discipline, a deliberate choice to trust a sound process, even when there is no immediate reward. Most people struggle with this because the human mind is wired to seek feedback. We want confirmation that our actions are working, and we want it quickly. Markets rarely provide that kind of reassurance. Progress is uneven, returns are lumpy, and long stretches of silence are normal. Patience is the skill that allows you to endure those stretches without abandoning what works. One of the biggest mistakes investors make is underestimating the time required for compounding to become visible. Early on, progress feels small because the base is small. Gains do not look dramatic, and this creates doubt. People begin to question their strategy, compare themselves to others, and look for faster alternatives. This is where patience becomes an advantage. Those who understand the nature of compounding know that the most powerful results come later, not sooner. Quitting early feels like action, but it is often the most expensive decision an investor can make. Patience also protects you from reacting to noise. Markets are filled with short signals that feel important but have little long-term relevance. News, predictions, and opinions arrive constantly, each one demanding attention and response. Without patience, Investors feel compelled to act on this information, even when it does not align with their goals. Acting too often creates friction and error. Patience creates space between stimulus and response. In that space, rational judgment has a chance to operate. Another aspect of patience is accepting that discomfort is part of the process. There will be periods when your investments decline, stagnate, or underperform popular alternatives. During these times, doubt feels reasonable. The temptation to change course feels justified. Patience does not deny these feelings. It simply refuses to let them dictate behavior. It recognizes that temporary discomfort is not the same as permanent damage. By staying invested through discomfort, you give your strategy the opportunity to recover and continue compounding. Patience also reframes how success is measured. Instead of focusing on short-term outcomes, patient investors focus on consistency of behavior. Did you follow your plan? Did you avoid unnecessary risks? Did you stay within your limits of understanding? These questions matter more than quarterly results. When success is defined by process rather than outcome, emotional swings lose their power. You are less likely to abandon a good strategy because of a bad year, and less likely to take reckless risks because of a good one. There is a strong connection between patience and confidence, but it is not the loud confidence of certainty. It is the quiet confidence of preparation. Patient investors are confident not because they know what will happen next, but because they know how they will respond regardless of what happens. This preparedness reduces anxiety and improves decision-making. When others panic or rush, patient investors remain steady. That steadiness itself becomes a competitive advantage. Patience is also what allows time to work on your behalf. Time smooths randomness, absorbs mistakes, and magnifies reasonable decisions. It allows small advantages to accumulate into meaningful differences. Without patience, time becomes an enemy because it feels slow. With patience, time becomes an ally. You stop trying to force results and instead allow them to emerge naturally from consistent behavior. Finally, patience reinforces humility. It acknowledges that markets are larger, more complex, and more unpredictable than any individual. Instead of trying to dominate that complexity, patient investors align with it. They accept what cannot be controlled and focus on what can. This humility reduces stress and increases longevity. Over the long run, patience is not just a virtue. It is a practical tool that turns discipline into durable success.